What's going on, folks? Happy April 3rd, Liberation Day +1. This will be a quick kind of pre-market stream here because we have a lot to get to inside of TTI. But to say that I am surprised would be false. I'm not surprised that the market moved the way it did. That doesn't mean that I was fully positioned to take advantage of any sort of shorts. But I'm going to reiterate something that we've been talking about inside of TTI for the last 6 weeks now, and over the last 2 days doing these pre-market streams, is that buying stocks under a 200-day moving average is a very risky business. You're either going to learn it the easy way by listening to somebody that's gone through the trials and tribulations of learning how markets work, more or less. I've been doing this for 15 years now this year. Buying below the 200-day moving average tends to be a more difficult buy than buying above the 200-day moving average. And then conversely, shorting above a 200-day moving average is more difficult than shorting below a 200-day moving average. It's the power of trends, right? If you're a technical trader, price comes first. With price comes trend. Trend matters to technical traders. Trends have been down for multiple weeks now, not only in the short term, but the intermediate term. If you're inside of TTI, we talk about it every Monday. We have a weekly trend update. We talk about the state of the S&P 500, the NASDAQ, and the Russell 2K. When these things flip bearish, we don't buy with full positions. We very much slow down in accumulating positions even if the primary trend is up, and we wait for more advantageous spots in the market. Over the last couple of weeks, there have not been any. As a matter of fact, we've streamed a couple of times. Just had a baby, my wife and I, and so I took last week off. But prior to that, we were streaming almost every single day, different types of reports. And one that I continued to get pushback on was our Bear Tracks report, which essentially looked at the weakest stocks in the market, right? We were looking through what was coming down in the market, even if the market was trying to catch a bid, which over the last couple of weeks, there were pockets of relative strength. Got a lot of pushback on that, saying that those stocks are going to rebound. Those are going to be the biggest winners. I'm not here to argue with anybody about the market. I have enough problem trying to argue with myself about the market. I don't need other people's opinions. But one thing I'm going to tell you is that weak stocks in strong tape tend to be the worst stocks to try to buy in weak tape. Things like Nike, which has done absolutely nothing this entire bull market. It peaked in late 2021. We've been in a 2+ year bull market, and it failed to rally substantially the entirety of the last 2+ years. And today it's down huge. It's down huge. Weak stocks in strong tape tend to be the weakest stocks in weak tape. That's the winning combination. So if you're looking to short stuff, which is very obviously on the table and has been for the last couple of weeks, look for the stocks that are underperforming. Do not look for stocks that are outperforming. You want to be short the weakest crap. Nike was an opportunity that we were looking at potentially taking short. We went through this a couple of weeks ago. Target is a short that we put on, and we talked about this live, right? If you guys were here a couple of weeks ago, we put the Target short on back at 120. It's currently trading right now at sub $100. We have a price target down near $90. Opportunity to potentially open up more target short exposure. But these are big moves. Check out the charts. They look relatively the same. There was no bid in these charts over the last 2 years of a bull market, so it's reasonable to assume that these are going to absolutely shit the bed on any sort of weakness. And now we have a market that's beginning to roll over, right? We have a market that is rolling over below a 200-day moving average. We can look at the S&P 500 again and ask yourself, is this an area in the chart that makes sense to buy? And hopes and dreams and everything else, and what you think about tariffs and what you think about the Trump administration or whatever, means absolute jack shit to the market. I'm sorry to tell you this. I might be one of the only people that will tell you this, but your opinion means fucking nothing to the market. It means nothing. You might get right every few times you throw some trades out there based off of what you think will happen. But without a sustainable system or strategy in place, you're basically playing roulette. Feel free, even, luck gets hit. Roulette tables, people win big occasionally, go back 100 times. Watch how fast you lose all of your money. It's the same thing with markets, guys. It's the same thing with markets. You have to have a system. You have to have something in place that is you can do over and over and over that will keep you out of trouble and give you an opportunity to make the best possible trades based off of the data in front of you. Data being price. So the S&P 500 is now not only below the 200-day moving average, but we are now in a 6-month low. We are gapping down, I believe, 3% this morning. There's going to be substantial amounts of people chasing shorts here. So is it the time to open shorts at open? Probably not from a swing trading perspective, at least if you're day trading. There's going to be opportunities everywhere today. So day traders, be on your P's and Q's here. From a swing trading perspective, do you really want to get involved in a negative 3% down day to the downside? Probably not. Probably not the best place to be opening up shorts here. We're looking to buy shorts on a snapback rally with the understanding that this is now a downtrend. This is a downtrend. Not only are we gapping down 3%, but we are gapping down 3% below a 200-day moving average within the beginnings of a bearish momentum regime. When we crossed the oversold mark in the RSI, came back up and tapped the 50 and started to get rejected, that was the beginning of a potential bearish momentum regime, meaning that the bears are in control of momentum, that the downside pressure should be greater than the upside pressure. Something that we were looking at for a potential reversal to the upside was a break above the 200-day moving average while having a break above the 50 RSI. We failed to get it. We rejected off of it. We didn't open up anything with significant size. Because of that, we waited. That was the right call. That was the right call. Wait for more information, wait for confirmation. We never got it. We didn't go long a bunch of Mag 7 stocks. We didn't go long a bunch of high beta stocks. We just sat there and waited, and we didn't lose a shit ton of money on this breakdown because, well, we don't buy below the 200-day moving average. It's such a simple fucking rule. Paul Tudor Jones gave us this 20, 30 years ago. Once again, if you don't learn it from me, you're going to learn it the hard way. Buying things below a 200-day moving average is an infinitely more difficult trade than buying things above a 200-day moving average. And just to, because I have to wrap this up pretty quickly, we have to get prepped on over in the Discord side of things. But I want to post something here because I see this all the time on Twitter. MACD is not some special indicator that's going to give you some sort of edge that other momentum indicators don't give you. It's great. It's fine. It's an unbanded oscillator, meaning that there's no maximum value that it can have. It can be as extreme as it wants, which is fine. But one thing that you can include in your trading to increase your probability of a winning position, whether it be to the upside or downside, while using the MACD as your moving or as your momentum indicator, is if you're looking to go long a market using the MACD crossover as your signal or a part of your system to go long, the MACD has to be above the zero. You're looking to go long when momentum is on the bull side of things. We call that a bullish momentum regime. We use the RSI. Lots of people use MACD. It's essentially looking at the same thing. MACD above the zero with a crossover is a higher probability long than a MACD with a crossover below the zero, something that a lot of people on Twitter are going to learn the hard way. There are a lot of people out there selling subscriptions on Twitter using MACD as a reason to go long. A simple rule that will keep you out of trouble over the long term is wait for the MACD to cross above the zero line, which is essentially the 50 line in the RSI, and then start going long. If you get crossovers below the zero line, the probability of that long sticking is greatly reduced. And then conversely, if you're looking to short with the MACD crossover to the downside below the zero. Don't short above the zero. These are very simple rules that occasionally will not work out, but over a sample size of 100, 200, 300 trades will give you an incredible amount of alpha. I just needed to point that out because a lot of people I see on Twitter and other social media platforms are using MACD as a momentum indicator, and they're using it wrong. It's not as easy as a MACD crossover, go long, MACD crossover, go short. Introduce that zero rule, and it will allow you guys to have higher probability setups. But from a standpoint of sector and industry strength, which is what we really like to focus on inside of TTI, I want to point something out here. If this is going to be some sort of wicked reversal, right? And I want to point this out. August 5th of last year, the Japanese yen carry trade blow up, that was a huge thing, right? Arguably mirroring kind of the sentiment that we have today. People were out on their soapboxes saying the end of the global financial system with the carry trade unwind and everything else, and it ended up being a week later arguably the best buying spot that you could have had. And we went long about 3 to 5 days after that August 5th breakdown because we saw that all the risk ratios and stuff were still telling us that there was a lot of bullishness underneath the surface, and that might have been an overreaction. I do not think that's the same. Risk ratios have been breaking down in the market for the last couple of weeks. We're looking at credit spreads potentially starting to blow out. We're looking at offense versus defense through consumer discretionary against consumer staple starting to really break down. This is not the same case for August 5th of last year. So we're not rushing in to buy the dip. But one thing that we want to do, at least inside of TTI, what we focus on is we understand that institutions move the market. It's not me. It's not you. It's not the anonymous fucking cartoon character on Twitter. It's not your favorite financial analyst on Twitter. It's not the guy on TV telling you to buy or sell. Nobody moves the market. In aggregate, financial institutions, the psychopaths, move the market, and their only motivation is to seek profit. It has nothing to do with politics or anything else. Well, the way that we can kind of view how they're seeing the market is through sector and industry rotation, right? Sector and industry rotation is the life force of a market, particularly bull markets. It works very, very well. Institutions gradually accumulate positions in certain sectors, and we start to get clues through sector strength or weakness. Something to point out here, this year, most sectors had done pretty well up until yesterday's market close, but tech and consumer discretionary were consistently lagging. There's a reason why inside of TTI, we have not been buying tech and consumer discretionary for the last couple of months at this point with any sort of actual size. We threw some feelers out there a couple weeks ago with AMD, but nothing really panned out. And so we said, this isn't working. Let's sit on our hands and wait. And here we have tech leading to the downside. Again, I mean, this is a theme, right? If a trend shows up on the 5-day chart, maybe it's not the end of the world. If it starts to show, once again, tech is down. If it starts to show on the 1 month, maybe it's starting to tell you something. When it starts to creep into 3 month, or at this point, it's the fourth month here. Come on, folks. That's how trends work, right? Trends tend to trend longer than most people expect. Weakness in tech should not be bought until there is some sort of bottom in place, and there is nothing here that is giving us the confidence to say that tech is bottoming. And remember, it has nothing to do with opinions, nothing to do with political bias. It has to do with price, has to do with divergences in momentum, has to do with relative strength. And quite frankly, we have to have a series of higher highs and start breaking some key levels to the upside. And we haven't done that in friggin' weeks. That's the difference between a sustainable system and some jackass on social media just throwing shit out there because their ego needs to be satiated when they get a right call. They need their legions of 50 to 100 anonymous accounts on Twitter to say you're the best, and then they jerk off into a sock, and it's the next day they get to have their next opinion. That stuff doesn't pay bills, folks. It doesn't. If price is in a downtrend and you're buying, eventually, if the market gives out, which it looks like it might be today, you're fucked. So there's a lot of people right now over-leveraged, over-positioned, buying tech drawdowns, consumer discretionary drawdowns with size. They're going to wake up and learn the most cardinal rule in trading. If you buy drawdowns in downtrends, you lose everything more or less, particularly if you're trading financial derivatives. It's absolutely insane. So what we're looking for before we call a definitive bottom and before we want to start buying this stuff is we're looking for divergences in momentum, and we should see this in sector strength, right? If the banks and the financial institutions, the professional money managers want to plant their flag in the ground and say it's time for tech to outperform, we're there for it. But it's simply not there. We will see it obviously on the 1 day first. I have no idea where this is going to be at the end of the day. But if there is some sort of true bottom being placed, we want to see higher beta areas outperform. What does that mean? Tech, consumer discretionary, communications. You don't want to see energy and materials and industrials and utilities. Those can outperform in certain pockets, but off of a bottom, off of a market bottom, is that what you really want to lead this bull market higher, or what a bull market should look like higher? No, you want the higher beta offensive areas of the market to be leading. So what we're looking for today is how sectors respond. Is it tech? Is it consumer discretionary? Is it communications? Are your Mag 7s being bought, or are they being sold off like crazy? Which, by the way, they were down over 20% as of yesterday's close. What do you think they're going to be down today? From an industry group standpoint, it's relatively the same. We want software, right? We want IGV over here. We want KRE over here. We want SMH over here. We want FDN, wherever FDN is over here. We want these leading by the end of the day if there is some sort of reversal coming in. If they're not leading, I'm not buying this crap. We want the higher beta areas to outperform, and it's not happening. If we look at year to date, you can see once again they are lagging substantially. Software is down 8.5%, internet's down 7%, semiconductors are down almost 12%. This is not a strong market to be buying dips in. If you didn't get the memo a month ago, you got the memo this morning. You don't need to go out and short everything under the sun. I don't think this is, from a swing trading perspective at least, I don't think this is the best day to be opening up shorts. Generally, particularly if you're trading options, you're going to want to wait for some sort of snapback rally. If you're trading options, it's very hard to nail a swing trade to the downside if you're buying them on big down days because the premiums blow out already. Any sort of consolidation or pullback and those premiums get zeroed out very quickly. So buying puts on green days and downtrends is the winning strategy for shorting, just like buying calls on red days and uptrends is the winning strategy. It's very difficult for most people to do because they want to chase price higher. Very, very bad. It's compounded. If you're trading options, it's very bad. So, and then to the short side, people want to chase a price down into the hole, and that's how you blow up. Even if you get the move, you're fighting premium, exorbitant premiums. You're fighting expanded implied volatility, inflated implied volatility. It's insane. So if you're not already short, don't fret. If you're sitting on cash, totally fine. There's probably going to be better opportunities to open up shorts. If you're over positioned long here, if you've been opening up tech for the last couple of weeks, just take it as a learning lesson. Everybody, I went through this. Everybody goes through this. I mean, this is a learning lesson for a lot of people. And hopefully the wisdom I can impart on you is that as simple of a rule as it is below the 200-day moving average, it does save your ass. I mean, seriously, just go back through history if you don't believe me. And it's such a stupid rule. But if we trade below the 200-day moving average, we generally have a sustained downtrend. If we trade below the 200-day moving average, most obviously, we're probably going to have, a sustained downtrend. You can look throughout history. These are substantial periods of time, by the way. It doesn't look like it, but that's 121 days where we trended lower. COVID was kind of an anomaly, but still, if you tried to buy the dip post 200-day moving average breakdown, you felt like the world was ending. That was a very hard trade to try to do. So use the 200-day moving average as kind of your guiding star if you have troubles differentiating between trend. There's other ways, obviously, to differentiate between trend, but the 200-day moving average is kind of the de facto way to do it. Institutions use it, banks use it, your favorite financial advisor uses it, everybody uses it. It's not the most perfect indicator, but it does give you an opportunity to understand where price is in terms of that kind of long-term trend here. So that's what we're doing inside of TTI today. We're going to wait. We're sitting on a bunch of cash right now. We've been more defensively positioned over the last couple of weeks. We welcome some sort of bottom here to form. If it doesn't form, we're going to be taking shorts on any sort of snapback rally because now we are trending lower, and that's how this stuff works. We survived the 2022 bear market. Most of you guys probably listening to this started trading in the last 5 years. If you survived the 2022 bear market, very low probability that this is going to look anything like that. But take the lessons you learned in 2022 and apply them right now. Live to fight another day. Remember, bear markets are for surviving, making money where you can, being aggressive in shorts, shorter time frame type stuff. And then when the bull market resumes, however that looks in the future, be ready to make all of your money back and more, right? That's how this stuff works. Bear markets are for surviving. Just don't blow up. Okay, my name is Hamilton here at the Trading Initiative. If you like this type of comment, please like and subscribe. If you haven't watched the last two streams, they're quick, 15, 20 minutes every morning we go live. Go watch those because I talked about this yesterday prior to tariffs. I talked about this on Tuesday prior to tariffs. We're below